This could be the most dangerous period the world has seen in decades. This is what Jamie Dimon, the CEO of the largest bank in the United States, JPMorgan, is saying. What has led the billionaire to make such a strong statement? Jamie Dimon has listed a series of risks that could pose challenges to the global economy and financial markets. One of the main issues could be related to inflation, which struggles to return to the 2% target, thus forcing central banks to keep interest rates at levels not seen since 2007. Other points that we will delve into in this video: high public debt that continues to grow, conflicts between Russia and Ukraine, Israel and Hamas, and the ongoing trade war between China and the United States. All of this could be a potentially disastrous mix for the global economy. A heavyweight figure in international finance, such as Jamie Dimon, has sounded the alarm. So, what should us common mortals do? According to Jamie Dimon, the prolonged war between Russia and Ukraine and tensions in the Middle East could have far-reaching impacts, with energy markets, food, global trade, and geopolitical relations being most affected. All of this could have repercussions on inflation, which, even though it is slowing down, remains stubbornly high in all G7 countries. It is well above the central bank's target of 2%, and high inflation forces central banks to keep interest rates higher for longer. Higher rates pose a problem for those looking to buy a house, a car, or take out any loans. When central banks raise their benchmark rate, all other rates in the economy move in the same direction. With the Fed having raised rates to a range between 5.25% and 5.5%, mortgage rates in the United States are currently above 7%, and it seems inevitable that they will reach 8%. Imagine what it means to buy a house with a 30-year mortgage at an 8% interest rate. Let's remember that the excess savings of households during the pandemic have eroded. Only the wealthiest 20% of the population have retained their extra savings accumulated between 2020 and 2021. These excess savings were used to support spending but are running out. Additionally, the growth of nominal wages for American citizens barely exceeds inflation. This means that, despite earning more on paper, they can actually afford less than 2 years ago, when inflation was much lower, close to zero. Most Americans are increasingly relying on credit cards to pay their bills. Total credit card debt surpassed $1 trillion for the first time in the second quarter of 2023. At the same time, default rates on credit card loans have increased, albeit at historically low levels. Higher rates are potentially lethal for businesses as well. Until 2 years ago, it was relatively easy for companies to find buyers for their debt in the capital markets or obtain financing from banks. With low interest rates, companies chose to refinance their debt, gaining greater operational flexibility, more cash resources, and more attractive profits due to reduced interest expenses. Now, companies may have to refinance their debt at rates they can no longer afford, especially if their earnings growth remains stagnant. A consequence of this could be cost-cutting, leading to layoffs, and this, in turn, causes average consumers to reduce their spending by cutting back on purchases of goods and services. As we know, consumer spending is the engine of the economy, and companies that can't make it may be forced to declare bankruptcy. The U.S. government also has to pay more interest on its debt, as it remains close to the record level reached with pandemic stimulus, and it is expected to explode in the coming years. As the CEO of JPMorgan notes, the United States has the largest peacetime fiscal deficit ever recorded, and American spending does not appear to be decreasing. In fact, the government is determined to pay the price of the energy transition, and as the population ages, healthcare and pension spending continue to rise. Washington is becoming increasingly divided and unstable, and there is still a risk of a government shutdown today. Congress has yet to reach an agreement on government funding for 2024. Last month's last-minute agreement will keep the government operational only until mid-November. The last U.S. government shutdown reduced the country's GDP by $3 billion. The loss of production by furloughed federal workers, the loss of public spending and wage payments, as well as reduced demand, cost the economy a total of $11 billion in the short term. In addition to this scenario, there are geopolitical tensions that represent a truly significant threat to the global economy. including the trade war between the United States and China that began under Donald Trump and shows no signs of easing. The United States has imposed several restrictions on trade and technology exports to China and rules aimed at keeping advanced microchips and production equipment out of China, trying to limit its geopolitical rivals' access to cutting-edge technologies. What's at stake here is technological sovereignty in the geopolitical framework. Now the latest chaos between Israel and Hamas has added to the mix, and the conflict risks involving other Middle Eastern nations, potentially fueling another wave of inflationary pressures. The worst-case scenario would occur if an escalation led Israel into a direct conflict with Iran, which is the supplier of weapons and funds to Hamas. This year, Iran has been crucial to the oil market, becoming the second-largest global supply source, while Saudi Arabia and Russia have cut crude production. In this scenario, oil prices could skyrocket, with deleterious consequences for global production. Jamie Dimon is preparing his bank for a wide range of possibilities to deliver results to his clients regardless of the economic environment. I would say that this is what all of us should aim for when uncertainty is so high, and there are so many factors combining to potentially turn things negative.